The global economy has never been harder to read. Two superpowers locked in a trade war. Trump is picking a fight with the world's richest man. Growth forecasts are being revised every week. Supply chains are shifting and markets are swinging wildly. So how should economies adapt? And how does this uncertainty trickle down? How does it impact your job, your loan, your future? India's Reserve Bank delivered its response today, and it went big. The Reserve Bank of India announced a 0.5% cut in interest rates.
After a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%.
This is one of the biggest cuts in recent memory, bigger than what most economists had expected, and the markets welcomed the news. Both the Sensex and the Nifty gained by around 1%. This is a clear signal to the world. India is taking control of its economic strategy in a world that is losing direction. And this is why the RBI cut the repo rate today. But what exactly is the repo rate and why should it matter to you? Well, in simpler terms, repo rate is interest rate. This is the rate at which the RBI lends money to commercial banks. Banks sometimes need money for the short term to meet the daily demands for customers, to process withdrawals, to lend to customers, and for their own operations. This loan from the RBI comes at a cost, an interest rate that banks must pay. And that cost of borrowing or interest is called the repo rate. Today, it has been cut by 0.5% or 50 basis points. That means it is cheaper for banks to borrow money from the RBI. And here's something you should know. This is an old tool. It's an important tool for central banks to keep the economy moving, to control inflation, and to manage growth. This move serves two purposes: boosting growth and reducing price rise. We'll start with growth. India has been doing well for itself. It remains the world's fastest growing major economy, but the growth rate has dropped. The momentum has slowed over the past year. In the last financial year, India grew at 6.5%.
We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047.
6.5% growth, that's a good number, but not when compared to previous years, when India grew at 8% on average. So there is a notable slowdown, and this is in line with global trends because around the world, growth has been sluggish. At home, the Reserve Bank kept interest rates high, but what happens when interest rates are high? Loans are expensive. Businesses and individuals take fewer loans. They invest less in new ventures, and this has a ripple effect on the economy. Lesser growth. Today's rate cut is an attempt to undo this. The rate cut will make loans cheaper. With cheaper home loans, people invest more in property. With cheaper business loans, investments get a boost. They can raise money to reduced interest rates. And all of this boosts growth. The second issue is inflation. And how is India doing on that front? Not bad at all. In April, inflation slowed to a 6-year low. It has dropped to around 3%. The RBI's limit for inflation is 4%, so at 3%, India is quite comfortable.
Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Its latest numbers are 3.2%, with signs of a broad-based moderation.
Food inflation has eased, fuel prices have normalized. This gave the central bank some breathing space. When inflation is high, a rate cut is tough because cheaper loans fuel price rise. But with inflation under control, the RBI can pump more cash into the economy. Their own forecast for this year says that inflation will be at 3.7%. Again, well within the ideal range, well below 4%. So this rate cut checks a lot of boxes. It boosts lending. It promotes spending, it gives businesses scope to expand, and it can put more money into the hands of people. But are there any downsides? Yes, there are. Lower interest rates come at a cost. They impact savings. They can impact savings, especially savings of pensioners and senior citizens. Many of these people keep their savings in bank deposits. They depend on them for a steady income. Rate cuts erode those returns because banks reduce interest on savings. They shrink payouts on fixed deposits. So while the borrowers stand to gain from this move, savers may end up losing. Those who use fixed deposits for stable returns, they may lose. In the months ahead, we could see a shift. More investors may turn to government bonds, debt funds, even the stock market. As interest rates drop, they can deliver better returns. But remember, these assets also carry a risk. So choose your investment vehicles carefully. Interest rates may be falling, but market volatility is not. The RBI's decision is a response to global uncertainty, to weak demand, and to shaky investor confidence. With this move, India is not just cutting rates, it is shoring up resilience and signaling stability in a time of global flux.
Firstpost now available in 9 languages on YouTube. English,
Stands at $36 trillion.
French,
Le FMI, comme
German,
geschäftsführenden Direktor,
Hindi,
$30 trillion ka karjo.
Indonesian,
Pemerintah tanpa pemeriksaan.
Italian,
Sekali radikali.
Japanese,
4 兆ドル以上も
Portuguese,
por causa do próprio balanço patrimonial.
Spanish.
Beautiful bill.
Go to Settings, click on Audio Track and select the language of your choice. Be the first to know what's happening around you in your first language. Firstpost.